Adobe just reported earnings. The stock is down 5.5% in the after hours. It's been really, really bad. The stock is down about 47% over the last year, and it's wiped out its last 5 year of gains. It's again very, very bad for shareholders. So I'm gonna talk about the report today. There's a few things that I like. There's a few things that I don't like in the Adobe report. So I'm gonna talk about it again, and I really hope you enjoy it as always. Now, the main sentiment around Adobe is that AI will absolutely destroy the business. But the company is not sleeping on AI. In fact, they mentioned AI 83 times. 83 times in their latest earnings presentation. So that really tells you that the company is looking at AI, they're not sleeping on it, they're not downplaying it. In fact, they're creating some AI tools which are gaining massive, massive traction. Now, normally, whenever you have a company that's dying, it starts to decline in revenues on a quarterly basis. Maybe each quarter it declines 0.5% in growth, 1% in growth. And that's normally how you identify a company that's dying. You don't look at the annual earnings growth or revenue growth, you look at the quarterly trend. And normally the quarterly trend will start to trend downwards in terms of growth. That's what happened to Celsius, that's what happened to Elf Beauty. But this is not what's happening to Adobe. In Adobe, it's the exact opposite. The company is reaccelerating in quarterly revenue growth from 10% to 12% to almost 13%. So again, this is the opposite of what you would see in a dying company. In a dying company, you would see a deceleration in growth. This one, we're seeing a reacceleration in growth, which is really funny to me, and the stock is going down. Now, if we look at the earnings report, or I should say the earnings presentation, they grew their monthly active users for Adobe Express and Acrobat from 700 million to about 850 million people year over year. So they grew their users by 150 million people. So again, this is kind of like Meta to me, okay? Because Meta is an amazing company because they have access to 3.3 billion people. They can launch Threads tomorrow, little to no cost. They advertise it to 3.3 billion people for free. Now, Adobe could launch a product, and they really need the right product. Like they need some kind of a new product to change the sentiment. You know, kind of like how Google launched Gemini and it changed the sentiment to an AI winner. Adobe really needs something different, like something new. But if they get something new, they can advertise it to 850 million people for pretty much for free because they already have those people in the ecosystem. Now, I'm going to talk about AI Assistant because I used it like 2 days ago, and that's from personal experience. I don't know anything about Adobe Acrobat. Like, I don't know how to use them. I don't know how to edit PDFs. I'm just not good with those things. So I was editing a PDF, and I was struggling with that. Then I saw something pop up. It says, ask Adobe AI Assistant. And okay, I typed in some questions. It told me, hey, do this, and this is how you edit this, do the signature, and this is how you do this. And it pretty much gave me everything. And it made my experience much easier while using Adobe. So that AI Assistant, as an example, it's a pretty good addition to a lot of people that are just not familiar with using a lot of Adobe products. And I think it was a great addition in general. Now, in terms of the AI innovation kind of revenues and AI first products, they increased by 3x year over year to greater than 500 million. So, you know, that's pretty amazing. And again, they have those AI first products, but they're kind of blended with the old products. But what I was saying is that if Adobe can come up with something completely new, like something where it's so big that people are talking about it on the internet and they're editing pictures or something with the app from Adobe that's like so revolutionary or something special, I think that would change the sentiment. But, you know, the company is doing what they can, and they're doing well so far. In terms of guidance, they actually raised guidance. Now it's about $6.05 to $6.10 for non-GAAP earnings per share. So if the company is doing so well, then why is the stock going down? Well, it's going down for a few reasons. The first one is the CFO has left the company. He's leaving on June 15th. Now, last quarter, the CEO left. Now the CFO is leaving. There's a lot of uncertainty whenever the CFO leaves, that maybe the new CEO will come in and he believes maybe they will not be able to meet guidance and they lower guidance or something happens. This is normally the fear whenever the CFO leaves. So now you have the CEO left and the CFO left as well. That, of course, will introduce some uncertainty to investors. But the second one, which I like to look at, is mainly analyst expectations. So those analysts from Oppenheimer and all those kind of firms, they really affect the company on a short-term basis because they upgrade and they downgrade the stock, and the stocks move a lot on upgrades and downgrades and all the price targets. So I watched this video to understand, this video on why this guy is bearish on Adobe. He said the profit structure of Adobe's business is deteriorating because the company's operating margins are deteriorating. Okay. Now, if we look at operating margins, he's actually correct. It went from 37% operating margins to about 34%. This is the lowest since over the last 3 years in terms of operating margins. So that would tell you that maybe Adobe is starting to cut prices, maybe they're increasing marketing for them to boost earnings per share growth or actually revenue growth. And that's what's causing operating margins to deteriorate, because they have more competition. And that could be a concern. He's actually right about it. I mean, normally if you have more competition, the company will have to advertise more, lower prices, and that ultimately lowers the operating margin in general. So that's something to watch for. If it deteriorates further over the next 2 quarters, that would tell you that maybe Adobe is actually getting disrupted. But so far, it could be more of a cyclical kind of event. As for example, from February, it was about 37.5. Now it went to 36. So you could see it declined from February to May. Sometimes it has to do with the billing cycle, where you have like annual subscriptions in February and some kind of other subscriptions in May, and it messes up with the margins. And the same thing happened this time from 37%, but it went much lower to about 34%. So that could potentially be a concern, and this is something that we have to monitor. If it deteriorates further over the next 2 quarters, then you know that maybe Adobe is actually getting disrupted, But so far, I'm not seeing signs of disruption. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But the stock right now, again, is very cheap. It's trading at about 9 PE, 9 times earnings for a 45% net income margin, 93% recurring revenue business model. You couldn't imagine that. I mean, the stock used to trade at 35, 40 PE due to the recurring revenues. Now it's trading at 9 PE. The management team believe it's undervalued. They've been buying back stock like never before. In fact, the only thing that's dying about Adobe is their shares outstanding. And they lowered shares outstanding a lot from 450 million, now should at about 400 million. So that's really, really good for the company. But if we look at the overall value, it's trading again at 9 PE, and they're expected to grow earnings per share 12 to 13%. So even if the growth gets cut in half, the stock is still extremely, extremely undervalued. Now, I always get the question that what is going to cause Adobe to go up? And I get the same question with Meta, because Meta is trading at 17 times earnings. The stock is not going up. What is going to cause those stocks to go up? Well, if they come up with a Gemini-like model or some kind of a major app or some kind of a major product that causes a change in sentiment, that's the quickest way to recover. But I believe all companies have some kind of a floor, you could say, where investors will look at them and they say there's enough risks priced in and it's time to buy the stock. And the stock recovers based on low valuations in general. And this is an exercise that I do on Meta and on many of my stocks that I believe are improving in fundamentals, but they're not moving. And I mainly take the earnings per share growth, I take the P/E ratio, and I assume that the stock remains flat over the next 5 years. And if the stock remains flat and they still grow the same they're growing now in earnings per share, where will the PE be trading at? So for Adobe as an example, now it's trading at 9 PE. If they grow 12% in 2027, which is next year, they'll be trading at 8 PE, okay? If they grow another 13% in 2028, they'll be trading at 7 PE. Now, how likely is Adobe to be trading at 7 times earnings 2 years from now, and the company is still growing double that? I think it's highly, highly unlikely. So the way I look at it is Adobe, there has to be a level where it's too cheap to ignore. I think we're getting very close to this level. And as long as the business doesn't decline in revenues, as long as everything remains the same, I believe a lot of the market will ultimately buy up the stock, but I just don't know when. But based on everything I've seen today, Adobe is fine. It's not getting disrupted. But if operating margins decrease further over the next 2 quarters, then maybe you could say the disruption is starting. If there's nothing else to justify it, then maybe the disruption is starting. But so far, so good. I think the stock's still undervalued, and that's my opinion on Adobe. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.